it was a pay $15,000 to save $25,000 over the next 3 years, but you don't even have to pay the $15,000 up front. You can tack it on, and my payments were still $700 less.
Welcome to the Tom Storey Show with Steve Karrasch and Tom Storey, where we discuss everything real estate or whatever else is on our minds.
Welcome back to the Tom Storey Show. Thank you for watching us on YouTube. Thank you for listening on the audio platforms. If you have not already liked and subscribed to the channel, we are very much appreciated if you did. On this week's show, Jesse Merson has joined us from the Vine Group in Toronto. He's a mortgage broker. He's my personal mortgage broker who used to work for the bank. And Jesse, I've been begging you for almost our 11-year relationship to come onto one of the YouTube things that I do and talk to me. And you didn't used to be allowed, and now you're allowed. So welcome.
Yes, thank you so much. It's great to be here. I think of it like this: as you see the animals in captivity and they're released into the wild. That's how I've felt the last 7 or 8 months. So
That's what happens when
thank you so much.
When someone from the bank goes to the broker channel and they can finally speak out loud.
Right.
Is that
right? Yes, exactly.
Well, one of the things that I had talked about on this show, and in fact, we almost did like a whole episode on it, was during the time that I was breaking my mortgage 6 months into it. I was very, I guess, honest with the audience on like, here's what's happening. Here's what I'm paying. It's going to save me $700 a month. And I was one of the fortunate few that got to renew my mortgage with a 6 in front of it at the end of last year. So I want to just start the show there. Now, This episode's coming out a few days before the next. It's looking like a 50-point cut. I think most people at this point believe that's going to happen. The bond yield on the fixed rate actually went up a little bit recently, but we still think maybe long-term that's heading down. So let's start the conversation there. Like, in your business, should people with a 6 in front of their mortgage be breaking it now, or should they be waiting?
Yeah, no, I think absolutely now is a great opportunity to look at that for many reasons. I mean, the top 2 reasons right now that people are breaking is to take advantage of today's lower interest rates. And so you can secure a fixed rate almost, or roughly 2% lower than anything above 6%. And if you're looking for exposure to the variable rate, which obviously went out of fashion the last couple of years, but a lot more confidence has come back into that specific product just simply because we've had 3 rate cuts. Consensus is another potential 2 50 basis point cuts, meaning 1% reduction just by the end of this year, which is 2.5 months. A lot of people are looking at that and want to take advantage of it. So there's the interest rate savings. There's also the potential to lower your carrying costs. And so a lot of people feel somewhat stretched with their current payment if, of course, they're paying that elevated interest rate. And so why not reduce your interest costs, therefore reduce your payment as well? So it's a conversation I'm having multiple times a day with people. And I think with the forecasts that are out there, now's a good time to take a look at it and just simply let the, math speak for itself. Take a look at what the breakage fees are, and run the numbers. And that's exactly what myself and my team do. And, we can sort of present those options to mortgage holders and say, here are some options, here's some opportunities, and ultimately make the best decision in terms of whether fixed is appropriate or, whether a variable rate is something that, people are comfortable with, or even the hybrid approach where you've got, both working for you.
I'm going to come back to this discussion, but Steve, I want your opinion on this. So Jesse, Steve is Mr. Fixed Rate for life. Okay. If he's Mr.
Awesome.
5-year fixed and it's worked out, and he's really been smug about it the last 3.5 years because it's made him look pretty smart. Right? People get lucky once in a while, but Steve, now if you were to buy a property now, knowing what we know about the variable, would you take a variable at this moment in time if you were buying, or would you still go fixed? And if you were to go fixed, would you go 3 or 5?
I'd go 5-year fixed. If I could get it around 4.29, I'd be set.
Does that exist,
Why wouldn't
Jesse?
I do that?
Yeah, I mean, definitely you can get in and around there. In fact, there's some, hyper discount lenders for insured mortgages. So your CMHC type of mortgage where you can actually get below 4% right now. I would just sort of say one thing. And I went back over the last 17 years to look at some mortgage rates, and really the last time fixed mortgage rates started with a 4 or even a 5, if we go back to the start of the year, was before the financial crisis. And so ideally, if the Bank of Canada does its job appropriately and barring any unforeseen events, if we get back to a normal rate environment like we had, say, summer, fall of 2019, we could see variable get back to its historical norm where it's typically priced 1% below a 5-year fixed. But I would say it's all comfort level, and when I'm talking to people and I can press on the advantages to both and the pros and cons to both. At the end of the day, it's comfort level, what works best for your family. And a lot of people's historical experience with whether it's fixed or variable is a large part of that decision. And the reality is we don't have a crystal ball. So the fixed rate has a ton of advantages. So does the variable. And so you just got to sort of look inside yourself and say, look, what am I most comfortable with? And let that drive your decision making, I think.
So what I'm thinking right now is, okay, so let's say we get this down to this overnight rate down to eventually 2.75, which everybody is pretty much in consensus that's going to happen. So probably it's not going to happen, but because everybody's in that consensus, and then we add 1% for variable, right? Probably
Or two.
your actual mortgage you're going to pay is probably going to be 1% higher than the overnight rate. I would assume maybe a little higher.
Yes,
but
right, including the discount. Yeah, about right. Yeah, for sure.
So now your variable rate is going to get on a 3.75 to 3.99 if we're lucky. Okay, so that's a regular variable product too, not like a HELOC like I have, which is higher. Mm-hmm. But then you have your variable or your fixed go in there, and it's going to be higher for sure. It's going to be at least half a point higher. So 4.29 doesn't make too bad of sense. Like I don't think we're going to go back to the 2.99 or even 3.75 5-year fixed. I don't think we're going to get there.
Yeah, it's a super tough call. I would just like to think that if somehow, the people that are in charge do their job well and make the appropriate forecasts, that we can get back to an environment or a rate environment like we had in 2019, and going back the prior 10 years from that even further, where things were very stable. I mean, Tom and I talked about this last time, there was a period where for 4 years, the Bank of Canada did not adjust their overnight lending rate, meaning variable rate mortgages did not change. And I think that's the kind of environment that most of us would want to be in, because when you have all this volatility, it makes it super tough to make a decision. Nobody's going to go spend whatever amount it is to buy a home, a major financial decision, when you're having these enormous rate swings. So ideally, if we can, get back to a stable environment, it builds confidence. It creates that churn in the real estate market, which you need as a first-time buyer, you need as an existing homeowner. But I think right now, if you are forced to renegotiate your mortgage or you're buying a home right now, what are the strategies that you can use to take advantage of where rates are today and make sure it still works for you 12, 24, 36 months from now?
So, Steve, what you just went through was saying, like, okay, if Bank of Canada gets to that 2.75, we know what it means for the variable. And I know the fixed is not directly correlated to what Bank of Canada does, but don't you think by the time that they get to 2.75 for the variable, that the fixed rate is going to be a lot lower as well?
At some point, it's going to have to reverse.
Right, because it's inverted still.
Right.
Yeah.
Right.
So if we're talking about this perfect world where everything just smooths out and everybody's happy and everybody gets to this spot where things don't change anymore, that's where we would be. And then the question is, does that happen within the next 5 years of signing on to that 5-year? Now, are we trying to time the bottom of I'm currently trying to time the bottom of the fixed rate market right now, because I'm considering floating on my variable line for 6 months or a year, and then seeing if it does get down there, because a 2.99 for the next 5 years would be fantastic. I just don't feel like it's gonna. I just really don't feel like it's gonna get there. I think we might be. I think 3.99 might very likely be around the bottom of the 5-year fixed rates, and there might be some people that make some bad decisions as trying to time the bottom of the rate market, if that's a thing.
So just take a variable and write it down.
Well, I mean, that's one strategy, right? Is go variable and look to maybe lock in 12 months from now if things plateau. But yeah, you guys are absolutely right. Like at some point, the rates have to get back to a normal environment where 5-year fixed rates are the highest. They get slightly lower the shorter in term you get, and then variable tends to be 1.5% lower than that. So we'll just have to see how that plays out. But we're coming out of the last few years that are a complete anomaly when it comes to what interest rates have done, the amount of money that's been printed, and the economics of it all are a very different sort of atmosphere than we're used to. So it's hard to make that call.
Now, Jesse, just a final thought on the breaking your mortgage side of things. So like in my scenario, I saved $700 a month. It was a pay $15,000 to save $25,000 over the next 3 years. But you don't even have to pay the 15 up front or whatever that number is. You can tack it on, and my payments were still $700 less. I know
Right.
my mortgage maybe situation was a bigger amount than maybe some people are dealing with if they've had mortgages longer than me, because mine was new. That's not a flex, Steve. That's not what I was trying to say. I was trying to say it was a newer mortgage.
My mortgage so big.
Trust me, I'm not trying to brag about that. But like, I think just people don't realize, and especially like, let alone the payment being lower, the interest you're saving at a rate
Well,
that's
that's it.
it's insane. And I don't think people fully understand until they look at these numbers.
Well, that's it. I mean, the savings you have on that payment. So in your case, that's $700 a month. That was all interest, right? The amount of mortgage that you owe doesn't change because you've adjusted your rate, or switched lenders or whatever. It's just simply you're now paying a lower interest rate, meaning less money out of your pocket to the lender, kind of thing. So yeah, and in regards to the breakage fees, typically that's not something that the mortgage holder would pay out of pocket when they're switching lenders or refinancing. They just tack it on to the outstanding principal, and of course that gets factored into the equation, right? When we're running the numbers to say, okay, here's how much your mortgage is today, here's how much interest you would pay to the end of the term, that calculation is compared to outstanding mortgage balance plus the penalty, equals interest costs, etc. And so that is sort of the direct comparison approach that we take a look at. And yeah, if you're paying above 6%, I think it's a great opportunity to revisit things. The other thing to keep in mind too is, at some point banks are going to start reducing posted rates, possibly by quite a bit, which is going to drive up breakage fees. And so that's something that, doesn't hurt to have that conversation. Have a mortgage professional take a look at your scenario and go, okay, yes, does it make sense? Yes or no? I think it's a pretty clean cut answer. And if it does make sense, then maybe you go for it.
So Jesse,
what type of penalties are you seeing right now? Like, what's your typical penalty for somebody breaking that's been in a mortgage, say, for the last year, and they're breaking now only 1 year, maybe 1.5 years into it? What are you seeing?
Yeah. So I've actually got a client right now. He's got 2 separate mortgages. He started November 23. He's paying, I think, 6.3 on one and then a little bit higher on the other because it's an investment property. And so he's got 2 years left on his 3-year term. The investment property penalty is closer to 12,000. Again, it's got a higher interest rate, so the interest rate differential is larger, meaning larger penalty. The primary residence is just over $9,000, and we're comparing that to a rate that's about low fours ish. So on both, he's saving 2%, and that's significant over the next 2 years. The investment property actually works out. I can't remember the specifics, but I think it's $7,000 to $9,000 in interest savings over the next 2 years just on that investment property. Right now, I think a lot of people are in sort of that holding pattern. Let's see what the Bank of Canada does next week. I'm more excited to hear about what their comments are going forward. Like, whether they do 0.25 tomorrow or 0.5 tomorrow, I don't think it's going to be a game changer. Psychologically, people may, feel better about the drop. But I'm curious to see what their thoughts are going forward, and if we are going, and if it's going to support some of these forecasts. To your point about what do we actually see rates come down 2.25 by July next year, which is on the radar for a lot of the bank forecasts. Is the Bank of Canada in line with that? How are they going to play this? And I think that could be very interesting anyway. So we'll see what they say.
And in most scenarios, when you're breaking your mortgage, are you changing lenders almost every time? Or is there cases where you can go to your own bank or lender and just say, I want to do it with you, but then maybe you don't have the better rate because the other bank knows they're getting the business from them when you're moving it over? Like, what have you seen?
Sure. I mean, I will typically see the lender change because I am going to be somewhat the proactive one to reach out and say, look, rates are lower. Let's take a look at the calculation. I bet a lot of viewers on this podcast could probably say, look, my bank has never called me to say rates are lower. Let's take a look at a refinance. That's not the bank model. That's more of a broker model, where we're sort of looking for that opportunity to save you money. So yes, you can stay with your bank to refinance 100%. There may or may not be legal fees. When switching lenders, you may be able to take advantage of a promotion that another lender has, like, a cash incentive. Some lenders will absorb or refund all the closing costs or switch costs, such as an appraisal or legal fees, right? So, definitely you can stay with your current lender, absolutely. But, I think if you're going to go through that exercise and apply, because again, if you stay with the same lender, you don't just sign a form and they, give you the lower interest rate, you have to apply. It's an opportunity for the bank to revisit your financials. So they'll take that opportunity, make sure you do qualify. So if you're going to go through that exercise to stay with the same lender, why not take a look outside and see, maybe, is there a cash incentive? Is there an even better deal or better product out there that's available for me? So
Steve and I have joked about it before, like the bank's not going to call you with like a reverse trigger rate call to letting you know that it's time to, like, and I say this lovingly because you worked at RBC for many years. I know many people at all the banks that I really like, but like they're a business. They're not your friend.
Right.
They're not going to go proactively out of their way, right?
No. And it's the bank model. And it's not that they don't want to call and maybe help out. It's just that it's not in their mandate. They're not incentivized to do that.
Yeah.
You may have your best friend as a bank specialist, then they bring your mortgage in and then it's handed off to a branch. And now that's where your relationship is. And the branch is busy with other things like credit cards and lines of credit and overdraft and maybe insurance. They're not making those calls when rates come down. They're going to call you at renewal time 100% because they want to keep your business. But again, that's another opportunity to take a look at what's out there, because if you are up at maturity, maybe you can find a better deal somewhere else, right?
Your real estate website should work as hard as you do, and that's where Realty Ninja comes in to create a beautiful website that helps you convert online leads, that doesn't give you all these tech issues and will match with the brand that you already have. Steve's been using Realty Ninja for over 10 years, and we have a promo code for listeners of the Tom Storey Show. RealtyNinja.com/Tom will give you 20% off your first year, and you don't pay a dollar until your website launches. RealtyNinja.com/Tom. And now, back to the podcast.
There's a chance, I think, that this opportunity, though, could be kind of fleeting. And you kind of alluded to it quickly there with the fact that as soon as that posted rate starts coming down, you're going to see, and this is what most people don't realize with their penalties. Your penalty is not like, this is your penalty, no matter if you do it now or wait for the rates to come down even further. It's tied to something called the posted rate, which is a magical number that doesn't mean anything to anybody except for the banks and how much money they want to make.
Right.
Yes. So when they post their posted rate and then that comes down, now the interest differential is going to gain a whole lot of steam. And I think as soon as that starts coming down, people are going to miss the opportunity because they're going to start that $12,000 penalty might start becoming a $25,000 or $30,000 penalty very, very, very quick.
Is every lender, Jesse, right. Does every lender do it based on the posted rate though, or only some?
So with fixed rate terms, fixed close terms, typically the lender will calculate your penalty two ways: 3 months interest or the interest rate differential, short form IRD. That's what everybody would sort of short form it to. But and then you're charged the higher of the two. And so the interest rate differential is a formula that allows the lender to recoup the amount of money they're losing. If you're, say, at 6% and they now going rates are 5%, there's a 1% differential there. They're going to recoup a portion of that, as the penalty. And you're absolutely right. As soon as posted rates go down, it drives up those interest rate differentials, and they can change very quickly. And so, just, on the flip side too, that helps to somewhat offset, but typically not as much as you would think, is with the rates going down, you would think, well, if my new rate's going to be lower, even if the penalty's higher, shouldn't I save more money? and it kind of closes the gap a little bit. You know what I mean? So it's not as generous as you may think. Again, it's still an exercise that I would like to go through and check those numbers and see. But yeah, when posted rates start to come down, and we'll have to see how this plays out, because if fixed rates come down a little bit more but start to plateau out because they start to hit that somewhat historical norm, and I agree too, is that fixed rates probably won't get back to where they were in 18 and 19. They'll probably be 20, 30 bips higher at the end of the day, as sort of a new normal level. Then we'll just have to run those calculations and see. But it'll be interesting to see how those posted rates play out. Mm-hmm. Keep in mind, a lot of lenders, a lot of banks do have these calculators available online as well. So you can go in and plug in your information and get a fairly accurate quote. I still would recommend speaking to somebody directly. But if you didn't want to do that and just sort of get a rough sense, either contact someone like myself, or you can go online and quickly run those numbers yourself.
So Jesse, in your business now, you've been doing this, is it 20 years yet? Close? More?
20 years. You can tell by the beard and the color here. Yes, that's right. 20 years.
So, you've seen lots of different rate environments. Obviously, one of the things that we always try to figure out, like me and Steve, we try to do our best in this podcast to tell listeners where the market is going, not where it is now, but what we're seeing in our business, that what will show up in the data in 90 days, right? Because it's the conversations are starting now. For you, with applications, with people that you're talking to, like, you have 20 years of data to look back at. Is it picking up now? Are people more encouraged by where rates are going? Or like the people that are coming in, I'm guessing most are end users, maybe a few investors are jumping in there, but what's it been like for you on a day-to-day?
I've definitely seen a pickup, especially since all the headlines started to come out. So definitely a pickup after the last 3 rate drops. I think people started to see that, and a reduction of 0.75 is something you can actually recognize in your cash flow. Now that we're expecting another potentially 1% by the end of the year, conversations have certainly picked up. We've also seen, around this time of year, a lot of existing mortgage holders are up for renewal. The numbers are out there. The headlines have been out there. There's an enormous amount of mortgages that are up for renewal, now going into next year and early 2026. Because of how active and how busy and how hot the real estate market's been across the country in the last few years. And so, that's created a lot of activity, for sure. I think also with these changes coming up, effective, I think it's December 15th, CMHC raising, from $1 million to 1.5. Overall, I don't think it's a game changer. I just think it puts us in tune with our local markets, Toronto and Vancouver, for example. And I also think that, in my experience, I've spoken to a lot of people that can afford a mortgage at that level, but just can't accumulate the savings fast enough for, call it a $1.4, $1.5 million purchase price. And so now that they've taken down those barriers to make it a little easier to buy, I think that will help a certain segment of the market. I also think it will help with the churn, and that's something I'm big on is, look, if you're in your condo now or your starter home now and you're looking to move up, your pool of buyers at the moment, first timers or anybody in that sort of price point, is somewhat limited. Confidence is down. It's super tough to qualify. And so if we start to get some of that churn and those entry level buyers come back to the market, that will help everybody sort of move up, I think, and I'm hoping. But definitely, I think activity is picking up. I think next spring, if forecasts are right and we're down 1.5% from here, we could be looking at a fairly healthy market across the board.
It's an interesting way to put it, because I had always thought, like, with going from $1 million to 1.5, like, Jesse, you know this as well as I do, like the semi-detached or detached homes in Toronto from $1 million to 1.5 didn't need help getting more demand.
True.
Those properties sold. So in my opinion, just long term, I do agree, though, it will make a difference from the person that couldn't go over $1 million because they didn't have the down payment and wants to buy a place for 1.1. Like that's going to allow them, but then eventually that just turns into price growth. But
I mean, I was going to say, like, the rules that are in place right now were put in place in 2012 when the average home price in Toronto was under $500,000. Now it's well over $1 million. And so if you're saying to people, look, we won't even insure the average home here in Toronto, I think that sends the wrong message, sort of, and maybe does put a roadblock in place for certain people. But you're absolutely right. That price point was super hot. But now the people that bought that at that price point 5, 6, 7 years ago, they may be looking to move up, right? The average Canadian moves every 7, 8 years, roughly. I think is the stat there. So if they're looking to buy, who's going to be buying that price point? Now it makes it easier. So maybe that will help get that engine going.
Steve, this is going to allow me to create an argument where if we go back and we say this was in place in 2012, it was time that we updated this. Well, the first time home buyer credit in Toronto came in, I think, similar time frame. I don't know exactly, but the prices have gone up so far that you should be getting more money back now. Like you can play this on both sides, right? Like if we're going to talk about one side, then it's like, all right, well, land transfer tax is ridiculous too. We should bring it down on the other side. The problem is it creates revenue for the city, and I guess it's hard to say no once that keeps coming in, right?
And the higher prices go, the more they increase the percentage here, right? So we have one where it's like they brought in the transfer tax, and it was 1% on the first 200,000 because only rich people own homes over $200,000. Then 2% on the balance, and then they brought in 3% over 2 million, and now it's like 5% over 3 million. So it's just like stacking up, but they're smart about it because they bring it in for only the rich people, and in 10 years, everybody's rich. So then we get tax money from everyone.
You're richer than you think. Another question with the new rules. So we talked about the insurance cap going up. Me and Steve have been pretty clear. Like we think the first time home buyer insured AM going to 30 is good. It helps more people get in. And in fact, that's part of the market that's really struggling right now with people not being able to qualify with the stress tests and the payments and things like that. So Jesse, these rules are December 15th. Tell me if I'm wrong here. My understanding is you can't close on the 16th and take advantage of these new rules. Like you gotta get it. It's after that that they'll even look at it, right?
Right. So at this moment, like as of today, it's just an announcement. And so on December 15th is the official announcement where it's supposed to take effect that day. So if you load an application today or buy a home today, the new rules will not apply. You'll have to wait till the 15th to actually submit your application for approval, which at that time of year is probably you're not going to see too much action. Probably January, February is where we'll start to see more of these types of applications come into play. So we'll just have to wait and see. But today, no lender is able to approve you under those guidelines yet.
So don't buy thinking that's a guarantee to close in December. Realistically, it's a new year closing at the earliest, right?
Right. Yeah. I mean, I would say, if you wanted to play it technically, you could potentially buy a home today, give yourself breathing room beyond the 15th, because that could be considered day one of your application process. Right. And then say maybe if you bought a home today, close February, March. Again, if anybody's watching this going, look, I think December 15th, things are going to blow up because we're going to have 30-year AMs and the cap's going up. I mean, you guys would be the experts there. I don't think we're going to see the world, the market explode based on that. Yeah, for sure. Activity may pick up. The phone might ring a bit more. But I think it'll take time for this update to digest into the system. So we'll see.
Jesse, when you first started in the mortgage business, were you giving out 40-year AMs?
They were there for a time, for sure.
And did it increase prices like crazy and create an issue? Like, why is 30 an issue now when 40 used to exist? And by the way, 30 existed under conservative governments as well. So it's not just like a political thing. We've had this.
No, yeah, for sure. 40 years came out. I'm trying to remember. They were put to an end in 2007 and 2008, I believe, during the financial crisis, which was driven in the U.S. by their housing crisis. And of course, by default, we were tagged along with that, even though our regulations are totally different. I think it maybe lasted a couple of years, I think, where 40-year AMs were available. And then it was reduced.
Did it push up prices?
I don't think so. I mean, maybe it did, sure.
It was 40 years zero down.
That's the problem.
Of
The zero
course it-
down's the
Right,
problem.
right.
Yeah.
It was a
Of course.
combo of a few different things for sure. Yeah, I think that I wouldn't be scared of a 30-year AM. I've read some articles about how, people are going to carry their mortgage for 30 years. And look, nobody that buys their first home, very few people stay in that home for 30 years. Typically, you buy your first home, your priority is cash flow, so you want a lower payment. As you get older in life, as their life stage changes, that's when amortization becomes more of a concern. But we're starting to see a lot more retirees carry mortgages into retirement for a number of reasons. Just housing prices, I think. Also, rates are lower today than they were 20 years ago, 30 years ago. So double-digit mortgages, you wouldn't carry that into retirement because your investments are not going to carry that. Whereas today, at 3, 4, maybe even 5%, you can make an argument that from a financial planning perspective, maybe you do roll it into retirement a little bit. Sorry, Steve, I defer to you on that one.
Let's in an imaginary world, let's pretend that some of those 40-year zero down people have never moved and they've never refinanced. Let's just say they just kept that thing rolling. They just got the new rate and the new rate.
Someone's out there. Someone's out there.
Oh, they definitely are. Call in if
I'd
you're.
love to hear from them. Yeah,
yes. Call in. We're taking live calls now on the show. So let's say so you still got 24 years left. But for me, I'm just thinking like when that was happening, I was looking at a townhome and they were 320 grand maybe, and now they sell for 850. So like you got 25 years left, but you got 25 years left at your $800 a month payment. All right.
And the equity you have in that home now, if you've held on to it for all that time, not bad.
The more interest you've paid doesn't really matter when the house has gone from 300 to 850, right?
Mm-hmm.
Okay, so let me play out a scenario for you, and I'm going to use this guy named Steve as my example person, okay? So Steve is a happy-go-lucky first-time home buyer in February of 22. Yeah, he's good-looking.
Older.
Yeah, he's really, really fit, has great hairline, everything's good. And in February 22, all of his friends and his family tell him, Steve, the market's going crazy. You got to get in. You got to get into this market. So Steve calls a mortgage broker, walks into the bank, and they say, hey, Steve, listen.
If you're a real estate agent in Ontario, you're well aware of what TRESA is and the new RICO information guide. And explaining that guide to your clients is of absolute importance and is mandatory. Now, we've been using an additional resource that we got from TRESAvideo.ca. It's been really helping our team have that conversation with potential buyers and potential sellers from the very beginning. Check out TRESAvideo.ca to learn more.
If you need insurance, you need to go where I go, squareone.ca. At squareone.ca, you can get a quote done in just a matter of minutes. If you're a tenant, landlord, or a homeowner and you need a policy, go to squareone.ca, or better yet, go to squareone.ca/The Tom Storey Show and save $20. That's squareone.ca/The Tom Storey Show for your discount on home insurance right now.
The fixed rate's so much higher right now. The variable is so much lower. If you want to qualify for more money to get your first property, you should go variable because look at the spread difference. This is February 2022, right? Okay. So Steve takes that variable, and unbeknown to Steve or anyone else, because it's never really happened, he took a static variable, okay? And he wasn't paying attention. He was living his life. He gets a letter in the mail one day. Hey, Steve, your payments have gone up. He's like, oh, what does this mean? And not only have your payments gone up, but your 25-year AM is now 42 years, or as we continue to go. So he rode out the wave, he made his payments, but he's been paying only interest realistically for the last year and a half, right? A little bit of principal. Now that the variable is coming down, are you seeing now on your end, Jesse, for people that had those silly looking amortization numbers when they got pushed out? Like, I guess how many more cuts do we have to get to? Is it ever going to get to the point where it's fully back to where it started? Not really, because we'd have to go so low in rates.
Well, yeah, you'd have to go so low in rate. The other thing too is I've had a lot of clients that have been hanging on to variable, but not the best discounts. There was a period there where 0.2 maybe 0.3 on a good day was a discount from prime, you can easily double that these days. So there's a lot of people that still have true conviction in variable and will say, look, now here's the thing to keep in mind too. If you're sitting in an amortization that's like 45, 50 years and you go to refinance, whether it's with your current lender or if you switch, you have to bring your amortization down to 30 years because that is the maximum. Yep. So that could impact things. So there's some people that, when we run those numbers, are not comfortable with a payment at 30 years. So they're kind of stuck where they are right now and will have to ride it out until things come back down. And if we do see rates come down 1.5%, 2% over the next little while, you'll start to see those amortizations fall quite a bit. But then there's a lot of people too, where, if you were to get out of that variable, so that example, the first time home buyer that went variable, if they can lock in right now for 4.5 or even less, and their payments come down and they can afford it at a 30-year AM, maybe that is a better scenario for them. But again, I think, what I do is simply present both options, and sort of say, well, here's how both would work. Here's the pros and cons in both. And not everybody is going to choose the same thing, right? I think that if you are in a variable currently and you're patient, I think at the end of the day, call it, 10, 12 months from now, you'll be rewarded.
Yeah.
Although, no crystal ball. And with a variable, you are always at the mercy of the economy and a headline that can skew things. And if February or March, somehow we get an inflation number that the Bank of Canada or any central is not comfortable with, they could put their rate reductions on pause, right? And now that forecast of down 2.25% by July next year is out the window. So that's something to keep in mind. Again, the other option in all of this is that hybrid approach. So if you do have 20% down or more, maybe you look at a little, diversification.
The 50-50 breaking up of...
It's not for everybody. Yeah, it's not for everybody, but it's an option. And again, it's all about options.
I want to get to rate cuts in a second, and I want to discuss that because that's coming up. When is it? This Wednesday?
It's
coming up.
The 23rd.
Like that?
23rd, yeah,
something like that.
23rd.
But
so Wednesday.
Let's
correct,
do another scenario right now where someone by mistake who is really stupid actually does well. Let's call him in this scenario Tom. And let's say, for instance, somebody at, I don't know, the bottom of the market of 2022 or maybe in 23 sometime when rates were really, really high, took a static variable. And now, through no fault of their own, they're probably going to pay that thing off in 15 years or 10 years because rates are going to come down to a spot where that static variable now looks like a smart move as opposed to 2 years ago when that static variable is apparently supposed to crush the real estate market. So it could actually be a good thing. The question is there a reverse trigger rate on those type of products? At some point, are you paying off too much where they go, oh, okay, we're going to lower your payment?
No, I've never heard of that. I've never seen that before. Again, Tom and I talked about this last time, was nobody really talked about the trigger rate up until, 2022. It just wasn't really in the vocabulary. It was there buried in mortgage disclosures as something that was there if rates were to ever shoot up. But it wasn't really, something that people, thought about or were concerned about. But you're absolutely right. Anybody that's sitting in a static payment and people I'm talking to right now are kind of, I would honestly say it's pretty 50-50. I've got some clients that want to have a payment reduce as variable comes down. And I've got others who are looking at it as an opportunity to go, look, I can afford a certain amount a month. I'm not too concerned about what the rate does. Obviously it goes down. That's amazing. And if it does, and I'm paying off more of my mortgage, hey, that's fantastic. 50-50 there, but yeah, that's one of those things. Again, come back to preferences and options. People will prefer one over the other. But yeah, the more it goes down, anybody with a static payment will see those amortizations drop because more and more of your money is going to paying off the actual mortgage itself.
Just like there's someone that hasn't moved that put 0 down on a 40-year, there's someone that took a static variable at the peak of rates that didn't really know what they were doing. And now just their payment is their payment. And you're right, Steve, they're going to pay off that mortgage wildly fast. Going the other direction. It could be a blessing going the other direction if you don't really know.
So talking about rates, let's do this two ways. Jesse, I'm going to start with you. First question, what do you think they're actually going to do on rate cut decision day here coming up in October 23rd?
I would love to see 50 basis points. My experience with the Bank of Canada is they do not listen to what everybody else wants. They kind of will focus on their own directive, which I understand. I do think we'll see 50 basis points, considering the latest inflation number we got was well under the target, well under analyst estimates. If it was in line or even a touch over, I'd say 25, but I'll call a 50 basis point cut next Wednesday. Final answer.
So you think that's what they will do? Now, does it differ from what they should do?
Should do. I mean, that's a great question. I would love, considering what I do for a living, them to drop 1% next Wednesday.
Yeah, right.
I would love for them to immediately go back to, they should immediately go back to where prime or the overnight lending rate was in 2019, but they can't because that could spur and backfire very quickly. If they were to announce next Wednesday, look, we're going to drop 1.5%, I bet car sales would go up. The Expedia website would crash. Clothing stores would be slammed, stuff like that. And that's what they want to avoid, right? Because then we're just back to square one. So they have to be gradual. It's going to be painful for the consumer and the mortgage holder potentially. But I think, and that's why I think the forecasts today have gotten a little more aggressive than they were at the start of the year, just simply because inflation has come down so much that they're looking at the most reasonable path to where rates should be without shaking things up too much.
Okay, Tom, same question. Yeah. What do you think what do you think they're going to do is the first question.
I think they're going to go down by 50 is my first answer. And then I didn't realize this until recently, and it's because I don't really follow the US side of things. The US doesn't include mortgage costs in their inflation data. Like if we had been tracking it like they track it, you take away the housing costs, we're at zero. Right. We're not at 1.6, we're at zero. Like I didn't realize the states didn't track inflation the same way that we do. We're like, because it's like one of those things, right? It's like giving someone that shouldn't have sugar a sugar cube, right? It's like, so it's like you're bringing down everything else, but pushing up all these side of the equation. So I believe they'll go down 50. And if now the economists are saying they expect 50 points in both now and December, what I would like them to do is just rip off the Band-Aid like they did in July of 2022 and go down a full point. Get ahead of it. Right. Just say, the market cools off at the end of the year anyways. If we're going to do this, it's time to do it now. Just get it done. So we're not even talking about December. December is going to be nothing, and let's move on to next year.
The timing of an even larger cut in December could be quite genius, because by that point in time, people may have bought all their holiday presents for the year. Right. You know what I mean? Book their winter vacation, and it wouldn't be an overnight bonanza of spending if they were to do more than 50 basis points in December. Because, as the saying goes, everybody's got their credit card hangover in January, February from the holidays. So maybe it would be a good time, because then it could digest into the system without things, blowing up too much. So
I changed my answer.
Could you imagine?
I changed my answer. 25 points in October, 75 points in December.
Can you imagine how bad the Instagram hashtag of real estate would go, like Real Estate Canada would go, if they did like a full percent at a time? Every real estate agent would be like, it's time to go. Let's do this.
But then on the other side, everyone would be like, you guys don't understand how bad the economy is if they went down a full point. The real recession starts 12 months after this. Get ready. Right? So it's both sides.
And the dollar. What happens to the dollar too, right? I mean, can't forget about that. There's a lot of people that need a strong dollar.
Tom, now ask me.
You want to participate? Okay, Steve, what do you think is going to happen?
I only ask you guys these questions so I could share my opinion.
That's mostly how I do the show too, yeah.
Yeah,
okay, go.
Right?
Go.
I've got something to say, so I'm going to pretend I care what you say, and then I'm going to say what I say. We could actually do this just by myself. I I think they're going to do a half point, and I think they should only continue to do quarter points continuously. I think they should continue to slowly just keep going back. And at some point, that's probably going to cause problems in the economy. But I think they should go, this is the trend we're going. We're just going to continue to trend until we're happy, as opposed to these jolts to the economy. Because if you do get, say you got a full crazy percent, that's going to tell the haves, the people that are in real estate, go buy real estate. And it's probably going to tell everybody else the economy sucks and you're all going to lose your jobs. Right. So like, I don't want to see these big jumps. I just want to see this nice, what are we going to call it? What do they call it? The smooth landing, or whatever the heck
soft landing.
Soft landing. Like, I think they're actually doing at this point an okay job with it right now, compared to like the other side where they left it way too low, too long previously. Like, they're doing an okay job, and it's like, let's just continue this. Let's just go, okay, another month. Not like, let's take a year to get to, or maybe even till summer, to get to like 275. What do we need to get to 275 to overnight? I really hope
if inflation comes in at 0.5 the next month, they have to, do they not?
That is the big concern, right? The big concern is like, look how fast inflation is dropping now. And then when we get to deflation, stuff goes bad real quick. So that is the argument for like, okay, so maybe like, what if next month we do go from 1.6, which was this month's data, to 0.5 or under 1%, because we're dropping it about 0.5% per month right now, and that's not necessarily a good
Isn't it so funny though? For so long, all we were talking about is inflation needs to come down, and now it's like, whoa! Don't come down too fast. Like we can never just be happy with what's going on. It's always like too fast or too slow in either direction.
Seems to be the case. It's it would be great to think that deflation is a good thing too, but that's when companies start laying off, right? That's when companies are like, listen, we can't make what we used to make. We have to, we know we can't sell our products because people don't want them, because they know they're going to be cheaper in the future. So we're not going to buy them now. Like, deflation is not a good thing either. And that's why the target is 2%, where people are mostly comfortable. And the fact that it has now dipped, it could dip a lot quicker than people think.
For sure.
I think it is dipping longer than, or faster than people think.
It's kind of lagging numbers too, right? Like, a lot of the, data that drives our inflation number, it's not the most recent. It's from like 30, 60 days ago, I think, right? Like, it's kind of a lagging thing. So we could be at 1.4, 1.2 right now, and we don't even know it. We won't know for another month or two. So we'll have to see. But
and if you go to, let's say we go negative.
When was the last time we had negative? When did that happen?
Did it happen in 2020? I'm not sure. I think it did happen in 2020 briefly. Okay. Like in lockdown and whatever at the beginning.
Right. Okay.
But that's where you go, oh, again, we only need that interest rate to be like 2% above wherever inflation is, right? So if it's -1, do we go back to a 1%? Like that, I don't think anybody, that would be good for anybody, but maybe it would be. No. Maybe it's what's necessary.
Yeah. Hopefully volatility for sure. Hopefully it's more like a pendulum where, the swings get lesser and lesser as we get back to center, right? But we could easily have rates, go down over the next 6 to 8 months, and then summer next year, all of a sudden spending's back up because rates are down and people are feeling good, and all of a sudden they have to raise again or something, a couple, and then come down again early 26 or something. Who knows, right? It's going to be a moving target for sure.
And I would just think, like, the average Canadian, they hear rates are coming down in the news headline. They hear inflation is coming down. But and I'm not talking about house prices here. What it used to cost you to live in 2018 and 2019 is probably never coming back. Like, even though inflation's down, everything is still more expensive. I'll give you a real life example. We had friends over the other day. We have a new baby, so when you have a new baby, people bring you
Big
food.
story. You don't have friends. You don't have friends.
Well, they were actually my wife's friends. To be clear,
Okay,
they were mine.
that's okay. This is now a true story. Okay.
Yeah. Anyways, they were super nice. They brought us over this little shepherd's pie, right? And we made it. And we ate it the next night for dinner, and it was delicious. And I flipped it over on the back. It was $24. Now it was delicious and from like not a name brand place, like a small
artisanal. It was artisanal.
Yeah, which you put that word in front of it, it just triples the price. But all I'm saying is that like I'm not talking about housing. I'm just talking about life. Yes, inflation's down from the craziness it was at, but like, you know, things are still, it's expensive. Like it's just expensive out there. And
travel and groceries, I think, are some of the more sticky things in the inflation number. Because I've been looking at, you know, taking the family on vacation, and prices today are not what they were before. And same with groceries. It's crazy how much groceries cost. So
like you can choose not to travel. You can't choose not to eat.
Right. Yeah, totally.
Right.
I should probably choose not to eat for a while. I got a couple of those pounds back on.
Hey folks, if you're looking for a real estate agent in the city of Toronto, let's face it, you gotta call my buddy Tom Storey of the Storey team and Royal LePage Signature in Toronto, Ontario. They're your obvious choice because Tom is not just the co-host of this podcast. No, he is a real life and top producing real estate agent in the city of Toronto. There's nobody out there that knows the condo market better than Tom and his team in downtown, but they do service the entire city of Toronto and any of your residential real estate needs. So if you're looking for an agent, do not hesitate to reach out to Tom, book a call with him using the link down below in the description of this podcast, and let Tom guide you through your real estate journey. And now back to the podcast.
All right. I'm going to try to get us back on track a little bit. There's an announcement. Let me just get to this, Steve. There's an announcement every other day now. Weird that they do announcements when elections could come at any moment. But the newest one was if you're going to refinance, and Jesse, break this down for me, the insured cap goes to $2 million if you're building a suite to rent out to, or not to rent out, but to give to a family member. Can you walk me through this?
So it's a curious one. When I first read about it, essentially, if you have a home worth less than $2 million, you can refinance it up to 90% of its value, insure it through CMHC or one of the other insurers to create a separate living quarters, a separate unit within the home, but only for basically your own use, which I don't quite understand it. I do in the sense that maybe demographics, people want their parents to be living with them, and that's great, but that's not going to solve the housing crisis in any way. You can't just rent it out to anybody you want. So it's an interesting one, Steve. I don't know what your thoughts are, but it's a curious change.
Is this our way to get our Airbnbs back? Is that what's happening? No, my thought is like, okay, so I didn't hear the part, actually. I watched the press conference. I was in Montreal, and I saw Chrystia Freeland, big housing announcement, and then I listened to her, and I was like, okay, I'd shut that off. I didn't realize it was for your own use or for family use or whatnot, which I guess might make it better. But my thought is like, as soon as I hear all this stuff about suites, like for instance, when the housing minister here in BC, maybe he's not the housing minister anymore. The election's this week. I don't know.
We'll find out.
But we'll find out. The spoiler alert. No, there's no spoiler alert. But when they made the announcement about we'll give you $40,000, give you to legalize or to put in a basement suite, it's all legal basement suite. Well, it costs like $85,000 to legalize. And so then everybody just puts in an illegal basement suite. So I assume this would be the same thing, right? Like if I'm putting in, why would I take out money to finance to pay for permits? Right? I'm just going to put in an illegal basement suite. I'm going to give my 90-year-old father-in-law a cooktop downstairs and a separate set of laundry. Like that's all I'm going to do.
How are they going to police this stuff?
How many people are going to use this or just use it to create a suite and just rent it out and not give it to family?
Yeah. Nothing stopping people from doing that.
Chris just sitting there going, what can I do to make it look like I'm doing something without actually having to do something? And they're like, let's make an announcement nobody will ever use.
Wait, let me play the other side though. Somewhere, there's someone listening to this and their parents live in a 4-bedroom, 3,000 square foot house. The cats have 3 of the bedrooms. They use 1. The kids are all moved out and they'd love for their parents to come live with them. It exists somewhere out there. Okay.
Or they're getting more cats.
Really, more cats. The cat needs a new room downstairs. This at least allows them to go through the motions of getting their parents to sell that house, bring that inventory to the market, and then they move in with them. So then that creates a listing, but doesn't create, you know what I mean, Steve? It's actually on the supply side of things, not on the demand.
They're not going to refinance to 90%.
Well,
to put in
fair
150,000, like it's a stupid nothing move.
Refi short and then get their parents to sell their house, and then they have the funds from their parents' house to pay it off quickly. Get where I'm going with this? All right.
No.
It's such a niche market. Like, I get it, but that's a niche market. Like, that's not really going to change a heck of a lot or solve a lot. Maybe it will for a very small percentage of people, but really to make a big stink about something like that seems weird.
If across Canada, 100 people use that in the first year, I'll be shocked. Right? Like it's just not going to happen. Yeah. Right. So we've got all these promises now. Like, again, we're recording this right before the election. We don't know who got in BC. You will know by the time this came out, hopefully. But they're announcing all this stuff where the government's now going to give you 40% of your down payment as a first-time home buyer. It's like, but also, if you're going to do that, you can't have a good income. It's like, what is going on? Like, who's actually going to do this? Well, if I go to a first-time buyer, hey, by the way, do you want the NDP owning half of your home or 40% of your home? They're going to be like, beat it. Like, what the heck is the point?
All right. I have a thought, and then I have a final question for Jesse, because it might take a little bit to answer this. So my thought is the home ownership rate in Canada has gone down. That is a fact. We can see that from Stats Canada. With the new mortgage regulations coming in, everything the government is doing, it is creating more demand on that side of the market, but not actually addressing the supply that people actually want. I'm not talking about building another 40-story condo. I'm talking about supply people actually want. It's not addressing it. Our home ownership rate could actually go up, but then the question is, what does it mean to be a homeowner? Does it just mean have a mortgage? Because if most of the new homeowners only own with 5% down, that's a lot lower equity than most of the homeowners in Canada. This is a tangent I'll go on another day, but I've just been thinking about it. And then Jesse, so Steve, I had Jesse on my main channel. It was an audition for the podcast. Absolutely crushed it. One of my biggest videos ever. You talked about something called the laddering strategy. Can you just break that down for us and for our listeners, and why someone may want to take advantage of that?
Sure. So the laddering strategy allows anybody that has a fixed rate mortgage, where the breakage fee, let's say, is prohibitive against refinancing the entire amount of mortgage. Okay. And so, like we were talking about before, the posted rates come down, the interest rate differential formula kicks in, the penalty is greater than interest savings to refinance the whole mortgage. If you have a product where you've got a built-in, you don't necessarily need a line of credit. It just makes it easier from a conversation and logistics piece to have that secured line of credit. A lot of people will have it tied into these types of products, collateral charge mortgages as opposed to conventional. If you have the resources, whether it's from a line of credit or your own cash savings, to make a lump sum payment to your fixed rate mortgage, and ideally you do want to have the line of credit for this, because it makes it easier to transfer, and I'll explain what that means. But basically, let's say you owe $500,000 and you're locked in at 6.3%. You have $100,000 available on your line of credit, and you have a 20% prepayment privilege on your mortgage segment, meaning you can make a lump sum payment up to $100,000 towards that $500,000 at 6.3%, and you can make that payment without incurring any penalty or breakage fee. You use the available $100,000 in your line of credit, You make that $100,000 payment to your mortgage. Now you owe $400,000 at 6.3, and you have $100,000 owing on your line of credit at either prime or maybe prime plus a half. Literally, the next day, you take that $100,000 that you owe on your line of credit, and you ask your bank to convert that to a brand new mortgage segment at whatever current mortgage rates are. So, for example, you could put it into a 3-year fixed at 4.5%, let's say, as an example. Now you've just taken $100,000 of your mortgage that you owe at 6.3 and converted it to 4.5%. So that's immediate significant savings. You haven't refinanced. You have not incurred any breakage fees. You've simply just saved yourself some money on interest and also lowered your carrying costs, because now $100,000 of your debt is, at a lower interest rate. So it's not a game changer by any means. It's just a way to, if you are stuck in a fixed rate where you can't get out of it, from a numbers perspective, that's a good way to sort of save yourself some money. And with that new mortgage segment, you have a number of options. You can literally choose any mortgage term you want. So you could convert that $100,000 into a variable rate. You could convert it into a term that's equal to what you have remaining in the larger segment, so that in the future they mature and come due at the same time, and you could potentially consolidate them into one. So you have a number of options.
Can you convert it to variable if you have less than 20% down on the property, or does it have to be over 20% to choose variable? Because then you're kind of doing the 50-50 kind of thing, right?
So to qualify for these collateral charge mortgages, where they allow you to segment your balance and include the line of credit, your minimum down payment is 20%. Okay. So if you bought your home with 20% or more, there's a good chance you have one of these products. If you have a conventional mortgage and you have 20% or more equity in your home, you can refinance and have one of these types of products where you take your conventional mortgage as it is now, whatever structure it is, and you can place that into one of these types of collateral charge facilities. So it's super helpful.
Makes sense to me. Steve, have you done that? I feel like your mortgage situations, like, I don't even really understand what you're doing, but you're moving things around all the time.
I'm definitely, I got to pull a move here in the coming 6 months. So I don't know what I'm going to do. That's a interesting way of possibly doing it. Basically I have a 2.75 fixed term that's coming up in the beginning of next year. And then the question is, do I roll it over variable? Do I lock it in? I'm thinking about floating it for a year before I lock it in, as I kind of said earlier. So here's
the thing.
Kind of stuck.
I know you're big. You're sort of a big fixed rate guy. And for anybody that's listening to this who agrees and prefers fixed rates, one thing you want to keep in mind in this environment is if you are temporarily looking to strategize a little bit, you could go variable and convert to a fixed rate later. Most respectable lenders will allow you to convert to a fixed rate at any time without paying a penalty or breakage fee. But one thing you want to do, and take the conversation a step further, are what are your options upon conversion? Because not all lender is the same. They will not offer you the same fixed rate terms when you convert out of a variable. So that's something to be aware of too, and just make sure that you are on side, and agree or like what you hear when it comes to those conversion options. But 6 months from now, I bet the rate conversation will be very different than it is today. So we'll see how things play out.
Final question, Jesse. What's the true answer between going into a bank and getting a mortgage versus working with a mortgage broker? You're the only person I know that's actually been on both sides. If I'm a consumer and I really don't understand the difference here, and I would say, I have a good relationship with a lot of banks, and I think I've got some really good products there. And for some people, it may actually make sense. Just go into a big bank and just get your mortgage there because it could make sense. But then you've seen both sides. So, what do people actually need to know? And I know it's going to be biased to broker. I get it. But what's the actual
I don't think it is.
Consumer? Yeah. Okay.
Sure. I think honestly, it's probably, we could fill up another episode or two on what all the differences are. But what I sort of all boil it down to is whenever somebody gets a mortgage, you're going to have it for a very long time. That's why 25, 30-year amortizations exist. These are not car loans that you pay off in a matter of years. They are long-term financial obligations. Buying a home is, for many people, the largest financial decision of their life. And having a professional that you can go to for that entire duration of that mortgage, I think is, especially somebody that you can trust, is a huge advantage. And that's where I find the biggest difference between bank and broker is. On the broker side, we will help you get in the door on day one. We will connect with you throughout, the first few years of homeownership. We're there when you look to refinance or move or buy an investment property or a cottage, and we know you. Whereas at the bank, it's a little bit different. The model is different. Not that they're not going to, take good care of you. Not that you're not going to get some great advice, but having a common denominator at the end of the day, that relationship person, I think goes a long way. And so that's how I would sort of answer that. There's a ton of other things, and I'd love to, break it down on maybe another episode one day if you guys would have me. But I think from a relationship piece and having somebody you can go back to is a huge advantage for sure.
Awesome. Well, Steve, any words of wisdom to wrap us up this episode?
Well, I think that's where the banks have lost it, right? There's a few people out there in their 90s that are like, my banker, but the banks have lost it, where you go into the branch and that person's been transferred, or they're not working today, or whatever it is, and they've lost that personal touch, which is why I tell people to never be loyal to a bank and only be loyal to your interests. Because, just recently I've seen things where fine print absolutely screwed my clients, and the bank doesn't care. The bank took that money. Thankfully, I worked the short sale and screwed the bank a little bit myself, and I feel really good about that. But, do what's best for you. Don't do what's best for the lending institution. So many people. I was talking to a guy this week, might be listening to this, and he's very loyal to a certain institution because that certain institution has provided him a lot of business over the years in his business, and that's great. And I understand that he wants to support that institution that's helped his livelihood. I get it. It's also the exact same institution that totally screwed a client of mine.
Right.
So
the other thing too you want to think about is the advice piece. What is the root of the advice that you're getting? And having spent a very long time at a couple of the large banks in this country, I took it for granted that a lot of the advice I was giving was somewhat biased in terms of only being able to offer certain products, certain, qualifying rules, etc. Whereas on the independent side, having access now to 70 lenders, here's the advice piece. Here's a few different options. You pick what's best. At the end of the day, I just want you to be confident in your choice and end up with the best decision, but it might come from here, it might come from there, it might come from over there. You know what I mean? So that's another major difference too.
Well, what I learned today is that all Canadians with a mortgage rate over 6% should be calling Jesse and finding out if you should be breaking it. We also didn't even talk about the fact that you don't have to be re-stress tested now. That was another announcement that came out when you change lenders.
Big one.
So lots more, Jesse. We'll definitely have you. We'll definitely have you back. Thank you so much for being here. We'll put your contact information down below, and we'll see everybody next week. Bye.
Thank you. Bye.